BlackRock manages over $10 trillion. That means when they publish a market outlook, people listen, not because they're always right, but because they influence how pension funds, sovereign wealth funds, institutions, and professional investors position money globally. And their latest outlook just revealed something really important. They believe we're entering a completely different investing environment, one driven by AI infrastructure, persistent inflation, energy constraints, and geopolitical shocks. So in this video, I'm going to break down what BlackRock is actually saying, what matters, what doesn't, and most importantly, how everyday investors can actually use this information. The most important idea in this entire report is this phrase, micro is macro. And honestly, this is one of the smartest observations in the whole document. What BlackRock means is a very small number of companies are now so large and spending so aggressively that they're influencing the entire economy. We're talking about companies like Microsoft, Amazon, Meta, Google, Oracle, and Tencent. BlackRock estimates these firms could spend close to $6 trillion on AI infrastructure this decade. That's data centers, semiconductors, power infrastructure, networking, cooling systems, energy generation. This is no longer just tech. This is economic infrastructure. And BlackRock believes this AI build-out is becoming large enough to affect inflation, bond yields, energy markets, labor markets, and overall economic growth. That's a massive shift. Now here's the part most retail investors probably haven't thought about. BlackRock believes AI could actually increase inflation before it reduces it. Why? Because before AI makes businesses more efficient, you first need to build the infrastructure. And building infrastructure is inflationary. You need more electricity, more copper, more transformers, more construction, more skilled labor, more chips, more financing. In other words, before AI becomes deflationary, it may first create a huge investment boom. And that's one reason BlackRock thinks interest rates may stay higher for longer than markets expect. This is important because most investors are still psychologically anchored to the old world. Low inflation, low rates, cheap money. BlackRock is basically saying that world may be over. So what is BlackRock actually positioning for? A few things stand out very clearly. First, they still favor US equities, especially companies benefiting from AI infrastructure spending, not just software, but the physical backbone of AI. Things like semiconductors, power infrastructure, energy systems, data centers, and industrial suppliers. Second, they like emerging markets tied to commodities and AI manufacturing, countries supplying resources, energy, or critical components. Third, they're increasingly cautious on long-term government bonds. This is a huge institutional shift. Traditionally, large investors used bonds as protection when stocks fell. But BlackRock argues that relationship is becoming less reliable in a world of persistent inflation and supply shocks. That's a major change in portfolio construction thinking. They also continue to favor infrastructure, private credit, and selective thematic investing. And honestly, when you zoom out, the entire report can almost be summarized in one sentence. Own the builders of the new economic system. Now, obviously, most people watching this are not managing billion-dollar portfolios, but this is exactly why understanding institutional thinking matters. Because eventually, what affects pension funds, banks, governments, and major asset managers flows through to everyday investors too. And one of the biggest messages in this report is this. The old investing playbook may be becoming less reliable. Now, what does that actually mean? For the last 30 to 40 years, investing was relatively straightforward, inflation kept falling, interest rates kept falling, globalization made goods cheaper, energy was abundant, and whenever the economy slowed, central banks usually cut rates aggressively. That environment massively rewarded long-duration assets, things like growth stocks, tech, property, and especially long-term bonds. And importantly, Stocks and bonds often balanced each other out. When stocks fell, bonds usually rose. That became the foundation of the classic 60-40 portfolio. But BlackRock is basically arguing that we may now be entering a different regime entirely. A world with more supply shocks, higher structural inflation, geopolitical fragmentation, energy constraints, reshoring, huge government debt, and massive AI infrastructure spending. In that world, inflation may stay structurally higher than people became used to after 2008. And if inflation stays higher, interest rates may also stay higher. And that changes asset behavior. Because long-term bonds perform poorly when inflation and yields rise. And if bonds stop protecting portfolios during market stress, traditional diversification becomes weaker. That's what BlackRock means by the diversification mirage. Now, this does not mean index investing is dead. And it definitely does not mean retail investors need hedge funds and complex strategies. But it probably does mean investors need to think more carefully about what they own, why they own it, and what economic environment they're actually positioned for. So what can normal investors potentially do differently? A few ideas stand out. First, understand what's actually driving your portfolio. A lot of people think they're diversified because they own multiple ETFs. But if all those assets depend on low inflation, falling rates, and US tech continuing higher, you may not be as diversified as you think. Second, consider broader exposure to real-world assets and infrastructure themes. BlackRock repeatedly highlights energy, power systems, industrial build-out, commodities, infrastructure, and AI supply chains. Because if the world is entering a massive rebuilding and investment cycle, the companies enabling that may benefit for years. Third, shorter duration fixed income may matter more. Institutions are increasingly cautious on long-term bonds, but shorter duration bonds can still offer income with less sensitivity to rising rates. And finally, this environment may reward flexibility more than blind passive investing, not constant trading, not chasing hype, but actually understanding the economic regime you're investing in. Because investing gets much easier when you understand the game the market is currently playing. This is exactly the type of content I want to bring to this channel. Breaking down institutional research, market outlooks, and asset manager positioning without the jargon. So if you want to better understand how the world's largest investors actually think, where capital is moving, and what themes may shape markets over the next decade, subscribe. And if you found this useful, leave a comment with which institution or report I should break down next. Because honestly, some of the most valuable investing information in the world is publicly available. It's just usually written in a language nobody explains properly.